Hello, everyone. Welcome to Layton's conversation for CPA Academy on the Low-Income Housing Tax Credit, the 45L, and the Inflation Reduction Act. Thank you so much for joining us today.
All right, and this is Jason from CPA Academy. I'm going to go through some quick introductory housekeeping items for all of you in the audience. If you don't mind, you can stay on that title card for a second. If you all don't mind heading on over to the Q&A section for all of you who are logged in, let me know that you can see all of us on screen. You should be able to see myself and David and Sean from Layton. And feel free to let us know where you're listening in from. We love knowing where you are. Most importantly, it's a great way for us to check that everything's working. And I'm seeing responses coming in from all over, so thank you so much for letting me know everything's working. Now that we do know everything's working, I'm going to go through a couple of quick housekeeping items. I know we have a lot of content to get to, so now that we know everything's working, I want to address the Q&A panel you're all using to check in. That Q&A panel is there for all of you to put any questions or constructive comments you might have for our presenters throughout the webinar. Please keep in mind that the only people who are able to see all of those comments in the Q&A are myself and our other moderators and presenters. So please be mindful that the Q&A is not a chat section. There is a chat panel. It is purposely disabled, so please direct all of your questions and comments into the Q&A panel. Additionally, the Q&A panel is where you can check in if you're experiencing any technical difficulties. We generally recommend refreshing your web page to reset your connection with the webinar platform. That usually fixes the most common issues. But if you do see anything unusual, please feel free to let us know over in that Q&A section. I know a lot of you are here for credit, so let me quickly address how credit works for this webinar. This webinar qualifies for 1 CPE credit and 1 CE credit for enrolled agents and PTIN holders. The way you earn the credit is fairly straightforward. You need to do 2 things. You need to stay logged in for at least 50 minutes, and you need to answer at least 3 of the 5 polling questions that will be offered throughout the webinar. So 1, 2, 3. Again, 50 minutes attendance, at least 3 polls answered, and you will earn your credit for participation. CPE will be issued by our team at CPA Academy a little later on today. CE credit will be registered with the IRS at a later date. If you do have any questions about the reporting of CE credit, please consult our FAQ page located on cpaacademy.org. And you can also access handouts for today's webinar, copies of the slides, right up in the handout section of the webinar interface. You can also access those handouts over in your CPA Academy account. And we have a lot to get to, so I'm going to step out of the way now and turn things back over to David to continue with the presentation. David and Sean, both of you, thank you so much for being here, and thanks to everyone at Layton for bringing today's content to all of you today.
Thank you for that, Jason. Much appreciated. So yeah, as mentioned, we're here to talk about the Low-Income Housing Tax Credit, affectionately known as LIHTC, and the 45L and Inflation Reduction Act. So a little bit about Layton to start with. Tax is complicated and business is hard. Layton guides taxpayers towards value through tax incentive opportunities that sustain and support business bottom lines. We're an international consulting firm with 27 years of experience across 14 countries and 3,000 employees. Since entering the U.S. market in 2018, Layton services have delivered over $500 million back to our clients. We have offices in Boston and San Francisco, so we serve clients coast to coast across the U.S. And now for a little bit about ourselves. My name is David Connor. It's a pleasure to be speaking with you today. I am a 45L project manager at Layton within our commercial real estate service line. I hold accreditations from the Building Performance Institute as a building analyst and the Solar Energy International for renewable technologies. I've been in sustainability and energy efficiency space for about 4 years.
I'm Sean. I'm Layton's senior 45L consultant. I have been doing Energy Star and Zero Energy Ready Homes ratings for since 2020, and I've been doing energy efficiency certifications for over 7 years. So just a little bit about me.
Great. So here is an overview of our topics that we'll be talking through today. We're going to begin with a just brief overview of the IRA, which is the Inflation Reduction Act, as well as discussing the 45L tax credit and updates that impacted it through that act. We will discuss the energy efficiency programs such as Energy Star and Zero Energy Ready Homes that are associated. We will jump into the alignment between LIHTC and 45L, as well as the historic tax credit and the 48 ITC investment tax credit. And then finally wrap up with some questions from the audience. So the IRA, LIHTC, and energy efficiency. These are the key takeaways we hope you take away with yourself today from our presentation. So the Inflation Reduction Act passed at the end of 2022, and it earmarked $668 billion into the U.S. economy. Part of that legislation included a revamp of incentives that were focused on energy efficiency, clean energy investment, and real estate development. So we'll be talking along those lines today so that you have some familiarity. The key takeaways we hope you have is that there are new federal energy efficiency standards like Energy Star and the Zero Energy Ready Homes. The updates that were done to 45L include these programs, as well as updates to the credit value, as well as bonuses that are now offered through prevailing wage. Prevailing wage is often associated with Davis-Bacon wages, and adherence with prevailing wage adds a 5x multiplier to the credit values for 45L, as well as the ITC credit, and is also included in some other credit deductions such as 179D. A very important point to note is that with the updates from the Inflation Reduction Act, there is no longer a basis reduction for taking 45L or ITC credits with LIHTC developments. This is very important to understand, as it's now brought into alignment that these programs work very well together, and we will have some slides discussing that. In addition, the ITC investment tax credit now has a 20% bonus that is applicable specifically to LIHTC developments. And we will also cover how cost segregation can be used with historic tax credits to benefit LIHTC rehabilitation projects that are renovating acquired properties. Lastly, an understanding that, this revamp through the IRA has aligned a lot of these energy incentives to maximize capital stacks, which is very important for LIHTC development deals, as we'll get into details. And there's also added tertiary benefits to adhering to these programs. Something that I sort of like to say is that the government is a terrible advertiser. And so CPAs like yourselves can help bring these opportunities to their clients and the market by understanding and being informed about how these program works. And that's really what we'd like you guys to take away today. So now I'm going to pass it over to Sean to talk about some of the energy efficiency programs.
Oh, Sean, before you jump in, I'd quickly like to say that poll question number 1 from that slide is now live. So we leave the polls open for about a minute for all of you in the audience to get your answers in. We can go ahead and close the poll in the background when it's appropriate to do so. So please get your answers in as quickly as possible. This is poll number 1 of 5, and we're going to close this out in the background after a minute. Sean, over to you, and thank you so much for letting me jump in.
Thanks, Jason. Go to the next slide. All right. Yeah. So this is just kind of a brief overview of the 45L energy efficiency home tax credit. The tax credit goes to builder, what's considered the eligible contractor. So the eligible contractor is the builder, contractor, or developers, whoever owns equity in the residential building project during the construction phase. The building types, and we can kind of dig into it more, but it goes to all residential buildings. But yeah, so kind of some overview for it is before the Inflation Reduction Act in 2022, all buildings that were residential and under 3 stories were eligible for the 45L tax credit at a $2,000 per unit credit. With the passing of the Inflation Reduction Act, starting in 2023, they changed the standards so that to be eligible for the tax credit, you need to either meet Energy Star certification or DOE Zero Energy Ready Home certification. And we'll kind of dig into that a little bit more later on. But up front, you should know is that with that, they increased the tax credit amounts. So for Energy Star, you can earn up to $2,500 per unit. And with Zero Energy Ready Homes, it could be up to $5,000 a unit. They also got rid of that 3-story height limit. So it can go up to, it can be as big of a high rise as you want. As long as it gets Energy Star certified, it still qualifies. Now, when we talk about residential homes, we're talking about apartment buildings, single family homes, townhomes, of course, but some other types that you might not consider are assisted living facilities or dorms and student housing, also qualify for the 45L tax credit. So we'll kind of just leave this up for a second, but this is a great visual for you guys to see what the different credit amounts are. And one thing you should definitely notice is that with multifamily projects, there is a prevailing wage requirement for the full tax credit amount. Without prevailing wage, it reduces, it's a 5-time divider compared to the full tax credit amount. So multifamily getting Energy Star certified is $500 a unit. With the prevailing wage, that goes up to $2,500 per unit. More specifically, though, is that single family, you'll notice, has no prevailing wage requirement. The full credit amount with getting any of the certifications. And we'll dig into a little bit more of the requirements of the pre-2023 and what exactly Energy Star and Zero Energy Ready Homes means in the following slides here. So what we like to call, at least at Layton, Legacy 45L is the Pre-Inflation Reduction Act tax credit. It was actually passed in 2005 and began implementation in 2006. That being said, it had to be reauthorized by Congress every year. And so some years they would forget and then retroactively reinstate it. That actually happened in 2022. It lapsed. It wasn't in effect for 2022. And then when they passed the IRA, they reinstated it for 2022. It is a $2,000 per dwelling unit tax credit. It compares a home to 2006 International Energy Conservation Code, IECC. And with the goals that you had to hit is that it has to be 50% reduction in heating and cooling load compared to that 2006 codes. You can still get buildings certified under this Legacy 45L through the open tax year. So buildings built in 2021 and 2022 can still be certified for the 45L tax credit under these older standards. A big part of this is, as I mentioned earlier, is that it would have to be done through amending, and it goes to the individuals based on basis in the project during the construction phase. So it's very important to have a full understanding of what the capital stack structure is of the project before pursuing trying to claim the Legacy 45L tax credit. And then a big part of this is that it requires third-party analysis by a certified HERS rater to do the energy modeling and certify compliance with the program requirements. So with the passing of the Inflation Reduction Act, we now have the two requirements that are either Energy Star Homes certification or Zero Energy Ready Home certification. Both of these are high-level green certificates that are created by the EPA with conjunction of the DOE. So there's a dual administration on that. And the incentive values, as we kind of talked about earlier, range from 500 to 5,000 per units. So, and as I mentioned, the prevailing wage can change what that amount is only for multifamily programs. So kind of an overview on the two certificates. Energy Star Homes started in 1995. It's really focused on energy efficiency as well as quality construction. It looks at the building as a whole system. So ventilation, insulation, appliances all go into those energy models. The kind of steps for it is there is energy modeling requirements to show that you're hitting whatever the target is for energy savings. Then there are on-site inspections with we'll kind of dig into it, but to verify what's in the model is actually what's installed on site. And then it gets registered with the EPA, the MLS, and the DOE. So there are over 2.5 Energy Star homes across the country, with 12% of all of the homes built in 2023 being Energy Star certified. And the adoption of both of these programs is heavily influenced by this 45L tax credit. The Zero Energy Ready Homes program was started in 2013, so it's a much newer program. While not net zero, it's supposed to be as close to net zero as possible. So it's supposed to be so efficient that with the addition of renewable energies, the home building, whatever it is, can be net zero. There's only 18,400 homes that are Zero Energy Ready Home certified. So as I mentioned, much newer, slower adoption on that end. It also has, in addition to the energy efficiency and quality construction of Energy Star, it really focuses in on water conservation and indoor air quality as well. So we'll kind of go over some of the requirements for Energy Star homes here. There's a single family, it's the Energy Star Single Family New Homes Program or the Multifamily New Construction Program. With single family, version 3.2 is required for all buildings being completed in 2025 to get the 45L tax credit. So it's very important that if you have any clients who are trying to pursue it, version 3.1 is what's in effect right now. But since it goes by date acquired, they need to be building to 3.2 now to get the credit in 2025. The only way to do the energy modeling for it is what they call Energy Rating Index, ERI pathway. So basically it gives you a score of 0 through 100. 0 is net zero. 100 is a inefficient 2006 code building. It gives you a target number in there that you have to hit. And it requires a pre-drywall inspection to look at ductwork, insulation, air sealing details before the drywall goes up. And then there's what's called a final test out, where you do blower door, duct leakage testing, double check ventilation, and confirm appliances that are installed. One of the components is that there needs to be HVAC testing. Now that can be done by either the rater or a credentialed HVAC contractor. One kind of important thing to think of is that townhomes count and row houses count as single family homes under the Energy Star definition. For Energy Star, a single family home is something that has a roof above it, either a slab or basement below it, and 2 exposed sides. So that's very important when considering if prevailing wage is required on the project or not, because single family, as mentioned, does not require prevailing wage. The multifamily program is on version 1.1. They actually are going to change that to version 1.2 for all buildings completed and acquired in 2027. They actually give you a couple of different options for compliance on the energy modeling side. So you can do a prescriptive path, which is just follow everything that's in the multifamily workbook, exactly how they lay it out, and you'll get certified. You can do the energy ERI pathway that was the same as the single family, which would only be for the units that get modeled, and then you do prescriptive requirements in all common spaces. Or you can do ASHRAE 90.1 modeling, which is what they do for the 179D deduction, if you guys are familiar with that at all. And that takes into the whole building into account when energy modeling. It also requires a pre-drywall inspection, and it does require blower door testing. Doesn't always require duct leakage testing, depending on how the HVAC systems are interconnected or not interconnected. So a little bit different of a process on that. Similarly, HVAC testing has to be done by what the EPA calls a functional testing agent, which can either be a professional engineer, professional mechanical engineer, or somebody with certain high-level HVAC credentials. Under the definition, if any of you guys are in New England, you know that triple deckers or double deckers are pretty common for housing types. And since it would have units above and or below one another, that would count as multifamily, where townhomes, row homes do not. And the baseline credit amounts are $500 a unit for Energy Star, $1,000 for Zero Energy Ready Homes, without prevailing wage on multifamily projects. So prevailing wage, very important for multifamily to get the maximum credit amounts. So Zero Energy Ready Homes requirements it's a little bit of a kind of shoot for the moon, you can land, or shoot for the stars and you land on the moon situation, in that one of the first requirements for Zero Energy Ready Homes is that the building gets Energy Star certified as part of the process. So generally, if you do not get Zero Energy Ready Homes, you'll at least qualify for Energy Star. Some of the additional requirements outside of the Energy Star component is that the building needs to be all electric ready. If it's using any sort of fossil fuel program, you have to have the wiring there to switch to all electric appliances. There is also a solar PV and EV charger ready requirements. So similarly, you do not need to install solar panels or an EV charger, but you need to have the wiring in so that it could potentially easily be converted into solar panels or EV chargers. Another thing with the Zero Energy Ready Homes, as well as getting Energy Star certified, is that all projects have to also get EPA Indoor Air Plus certified. So that's just focusing in on controlling moisture in the building, making sure there's no materials using harmful chemicals used on any indoor spaces. As I mentioned on the top, there's a big component for water efficiency on the program. So there's either certain water efficiency requirements that you can meet, or you can go through another EPA program and get the building as a whole WaterSense certified. And both options are available for compliance. Unlike Energy Star, the version that you're required to use does not go by date that the building is acquired by somebody for residential use. It goes by permitting date. So there's a little disconnect there between Energy Star and Zero Energy Ready Homes that is very important to be aware of when planning to pursue either certification. And because Zero Energy Ready Homes is a higher level green certification, it's the one that gets the max credit amounts. So this is just an example of some multifamily apartments we've worked on it was actually a LIHTC job in the greater Boston area. It was 300 units. It was pursuing Energy Star as well as prevailing wage, since it was part of their LIHTC requirements. So they were eligible for the full $2,500 per unit tax credit, which gave them $750,000. Let Jason take over on that.
All right, I'll just quickly jump in for poll question number 2. Just like poll number 1, we'll leave the poll open for about a minute while you all get your answers in the background. Please make sure that to respond to the poll, you click the option corresponding with your answer and then hit the submit button to confirm that response. This is poll 2. We will have 3 more polls after this, 5 total. So I will turn it back to you, Sean, to continue presenting, and we'll leave the poll open until it's time to close it out in the background.
All right. So now we're going to start talking about the low-income housing tax credit. This is just to do a brief overview and some history around the credit itself. So it initialized and was first introduced in 1986. It is the most common way to incentivize affordable housing development in the U.S. The credit supports the cost of new construction as well as rehabilitation of existing assets for use as affordable housing rental units. As you can see from some of the stats listed here, it's a widely popular program due to these factors. Over 50,000 development projects have used LIHTC since its inception, and on average, around 40 to 70,000 units are added every year to the housing supply via LIHTC mechanisms. So it's got bipartisan support across the board, which is why the program's so popular here. As you can see, lots of tax revenue generated, local income as well as jobs have been created. So the credit is calculated as a reflection of the building's basis for the project cost and what's going into the building. And this is why you can have rehabilitations as well as new construction utilize LIHTC. The credit does pay out over the course of 10 years. And to access the LIHTC credit, projects have to meet certain eligibility requirements, such as rent pricing, as well as required hold periods to keep those units as affordable. So this is a graphic that's going to go into how these credits work as far as the different partners involved and what's flowing through and where. It all starts in the center with the developer. So the developer comes up with a project, a plan, they get their architectural drawings together and they're going to submit that as part of their plan to the Housing Finance Agency. Federally, this is the office known as HUD, Housing Urban Development Office, and they are the federal program manager for LIHTC credits. They disperse funding to state allocation agencies. So based on where the project is, those state allocation agencies will receive the proposal submission from the developer, and they will award the tax credits back based on which projects they want to move forward with. So there is a competitive process in the bid there, and not all developers will always get LIHTC credits. They have to essentially win them. Once they've been awarded those credits, that allows them to take that back and build it into their personal capital stack. And generally what we see at Layton is that developers will reach out to investors through syndicate schemes and syndicators that connect these investors with the developer. And what the developer offers is a ownership interest based on equity percentage in the project for financing back from the lenders. What this essentially does is allows the developer to free up their capital while utilizing the investor capital to cover the cost of project development. And what the investor gets in return is access to those LIHTC credits that they may pay pennies on the dollar for that will realize profitably over that 10-year realization period. So while all of this is occurring over that 10-year period, there's opportunities for loans to be used, whether it's refinancing or grants and incentives from other sources, as well as operational income coming from the rent itself within the units. So what's required to get LIHTC? How does this work? What you have is generally there are two types of LIHTC credits that are applied for. There is the 9% credit, which is usually seen in new construction, and in practice covers about 70% of the cost to build. And you also see the 4% credit, which is usually seen in renovation and rehabilitation projects. And this will cover about 30% of those associated costs on average, but it also allows the use of additional federal subsidies, such as the historic tax credit that we'll talk about a little later. If new construction uses a 4% LIHTC credit, they do require that tax-exempt bonds are part of that financing structure. The official minimum criteria for the number of affordable units in a LIHTC project is as little as 20%. But it's really common that you're usually seeing almost 100%, if not 100% of the units being affordable. Because as I mentioned, there is a competitive application process here. So to ensure awarding, most projects want to maximize the LIHTC offering for the number of affordable units, and that way they can maximize the amount of credits that they would be receiving should they win that award. To be considered affordable, the parameters at play is that 20% of the tenants are required to have incomes of 50% or less from the area medium income AMI, or that 40% of the tenants have 60% or less of the AMI, or thirdly, that 40% of the tenants average 60% of the AMI, with no tenants above 80% of the AMI. So you can see there's a lot of eligibility factors here that need to be documented in order to substantiate all of this. As we mentioned, there is a hold period associated. The credits paying out over 10 years is one half of that. The other half is that there's a minimum 15-year hold period for the property before the owners can sell, re-up for credit, or move on to market rate unit rent. However, some state agencies often increase that hold period, and we've seen as high as 30 years for a necessary hold period before that's possible. But once that's hit, and we've hit that sort of end of the LIHTC requirement hold period, owners can either sell the asset, they can re-up for additional LIHTC credits if that's the way they want to choose, or they can move the units to a market rate rent. So that's often the three outcomes that come. As I mentioned, there is an investor component here that's often familiar with LIHTC deals. Syndicates essentially operate to connect developers using LIHTC credits with investors who are interested in pennies on the dollar deal structures to profit from them. So syndicate investors, usually receive a steady stream of tax credits to offset their tax liability, and developers in return are getting an upfront debt-free financing for their project. So that's kind of where the quid pro quo comes in. What we're looking to exchange is equity in the project for deal financing, freeing up capital. The amount of financing is generally dependent on the total amount of credits the project receives over the lifetime. And this is why having things like the 45L, HTC, or the ITC credits can often be beneficial to these deal structures, as it creates additional value for the investors to be attracted to. In addition to the credits I mentioned, we also are seeing new market tax credits at play, as well as other energy efficiency tax credits and state level tax credits. Many of these investors come from many different backgrounds. Sometimes they're high net worth individuals through private equity funding, but they can also be institutional investors coming through large scale banks and financial mechanisms. So this is a snapshot to look at where LIHTC is heading towards. A little bit of history here going back to 2013. And it's very clear based on the graph that there's an expected drop-off currently forecasted for LIHTC. But right now here in 2024, we're looking at about 70,000 new LIHTC affordable units that were added to the housing supply. And it's forecasted that down to the low point of 2027, that should drop off about to 35,000 units started. A lot of the uncertainty here has to do with the market conditions. As mentioned on the slide title, there's some high interest rates at play. Financing is an interesting situation at the moment where no one really knows what the future holds. It's also an election year. The child care tax credit that has currently been hung up in Congress this year does include a lot of funding that is available for LIHTC. So when this data points were made, it was forecasted that this deal may not pass. Thus, there would be a drop off on funding and starts would be slowed down. No one can predict the future, but depending on if that child care tax credit does move forward, that may change the shape of LIHTC to come. So as we mentioned, there's lots of benefits for pairing additional credits with LIHTC. We've talked about the 45L working well with the syndication of credits for several reasons. On a technical standpoint, building codes more and more recently are requiring energy efficiency measures simply to get permit sets approved. So a lot of times we're seeing with clients that it's easy to bridge the gap between what is required for permitting approval and achieving these energy certifications. In crossing that gap, we are able to create accessible credit money via the 45L within year one. So these syndicators that are putting investment capital up have access to what we call soft money immediately available in the first year that is not tied to a payout time or already established, with its flow through. As mentioned previously, 45L before the IRA actually reduced the basis for LIHTC calculations as taking a credit, which would affect the basis of the building. The IRA specifically called this out. So now that there's no longer any reduction in basis, investors and syndicators seem to be keen on getting this 45L credit included in this capital stack. Again, also 45L having the benefit of prevailing wage. LIHTC developments are often commonly seen, prevailing wage included, as part of the requirements for funding. As I mentioned, some of those federal subsidies that might come in to play require prevailing wage to be paid. So again, this alignment of getting the maximum value of 45L is much more easily achieved. In addition, we've got energy efficiency programs that satisfy the HUD office green building requirements that allow them to access lower mortgage insurance premiums. So this can be a beneficial aspect when considering refinancing for the project. Again, no basis reductions. This also includes the 48 ITC. So if solar and renewable technologies are in play, additional benefit can be created within the capital stack there. Next slide. So the other half of this is a little less on the fiscal end, but there's lots of benefit here just simply for including these programs within your affordable housing developments. You know, clearly there's a reduction in energy costs and operating costs. So utility bills for the property are going to be lower, which is easy on developers as far as operational costs. Tenants generally like a more energy efficient building. So there's some marketing aspects that are included from getting that. The state usually has also energy incentives and rebates available for adherence to these programs, or components that get purchased for inclusion in these programs. And additionally, you know, support of environmental stewardship goals for companies. There's value add included into these properties. Once the hold period is ended, we generally see that units that have one of these energy certifications are selling at about 8% higher than units that are exactly the same without. So there's a value add benefit. And of course, marketing. You know, we are moving into a green future, and developers and lenders that are supporting that future's reality can stand behind these kind of buildings and what they're doing there.
All right, I'll jump quickly back in for polling question number 3. So everybody please go ahead and get your answers in for polling question number 3. Again, if you are having difficulty answering the poll question, please make sure to refresh your webpage in order to reload the webinar interface. And you may need to click at the side of the poll boxes in order to find the radial button that will be selectable to answer the poll, and then you can hit the submit button to confirm your response. So please go ahead and get your answer into poll question number 3. We will have 2 more polls after this. And David, Sean, I'll turn things back to you to continue presenting, and we'll close the poll in the background.
So I'm going to talk about cost segregation, which, you know, it's a little bit of a path to get to why cost segregation makes sense with the LIHTC project. I just want to address one thing quickly from questions I'm seeing in the Q&A. The 45L tax credit is non-transferable and a non-refundable tax credit. So it cannot be sold on tertiary markets. One of the reasons it works very well with the LIHTC syndication program is because it flows to the syndicates based on their basis in the project, since most of the time the developers are giving up basis in the project in return for upfront funding. So I just wanted to clarify that for some people in the Q&A, and then we'll get into cost segregation. So Ram, who you may have seen answering some questions in the chat, is a cost segregation expert. I am not, but I can talk to a bit about how it's basically an engineered method of accelerating depreciation by changing assets into personal property and land improvements from the building structural assets. And because it is accelerating depreciation, generally with LIHTC, you wouldn't think that cost segregation would work because of the basis requirements for which determines your LIHTC credit amount. Just a brief thing that there is bonus depreciation. I believe right now it is at 80% this year, and it's going to go down to 60% next year. But what that bonus depreciation is going to be changes with the tax laws. And so there's a potential for that to go back to 100% bonus depreciation going forward. So what is the historic tax credit? It is a tax credit for buildings that are designated historic by the National Park Service. To qualify, they must meet the substantial rehabilitation test, which we're going to talk about a little bit on the next slide. There's federal standards for what that rehabilitation work looks like. And the property must be income generating over the 5 years that that tax credit pays out. And what you get is 20% of all the qualified expenses back from the rehabilitation. And with the 4% LIHTC tax credit being mainly for remodels, we see this historic tax credit leveraged a lot for 4% LIHTC projects. So the substantial rehabilitation test is that the adjusted basis of the property, once you take out the value of the land, the rehabilitation, the costs of rehabilitation must exceed the adjusted basis of the property with the value of, or the basis of the land subtracted. So if we look at this first one, we're going to kind of work through this, is if you have a cost of property of $5 million and the land value of the land is $1 million, the substantial rehabilitation test would be $4 million of the adjusted basis. And you would have to spend $4 million or more to qualify for the historic tax credit. So if you do cost segregation before you take the historic tax credit, you reduce the property basis by, in this case, we're using an average of 20%, by $1 million. So then you have a property basis of $4 million. Then you reduce it by the value of the land, $1 million. Then you only have $3 million of adjusted basis that you'd have to spend to meet or exceed that substantial rehabilitation test. So why does this all matter for low-income housing tax credits? Sorry, do you mind just going back one? Just to kind of sum up why this all makes sense is that if you were to buy a property that you plan on using a 4% LIHTC project on, or LIHTC credit on, you can, if you do cost segregation, it lowers the amount of money you have to spend to include the historic tax credit into your capital stack, making it something that you can easily add in, or more easily add in, when you're going and taking the project out to look for syndication or investments.
Awesome. So we are now going to move into talking about the investment tax credit 48. It has been around in some iterations prior to the Inflation Reduction Act, but it really got a revamp here. So for all intents and purposes, we are saying it is from the Inflation Reduction Act. And what is it for? It is a recoup cost, like a general business credit associated for clean energy technology investment. Commonly, we all think of solar as well as wind, but other ones that are included in this could be things like geothermals. You may have heard of geothermal heat pumps, hydropower, all the way down to even waste energy recovery within the property. What it allows to capture is up to 30% of all the related costs needed to implement. This includes design costs, infrastructure updates, equipment purchasing, as well as labor time. So not simply just the cost to purchase the equipment, but there's much more nuance that goes into it. Additionally, there are bonuses from the IRA, as well as new legislation passed just this year that add into improving the payouts for this ITC credit, and it can actually maximize all the way up to 70% of these costs being covered. We'll talk a little bit more about that in some coming slides. So we have the overview. As mentioned, there is a consideration into what those costs for the project are that aren't just beyond, that are far beyond just the equipment cost purchased. It can be taken on existing as well as new facilities. So again, say you had a renovation project where you decided to redo a roof in order to put roof mounted solar on that, that would consider as an infrastructure update to an existing property that would be qualified. It could also be for a complete new construction project as well. It acts as a general business credit similar to the 45L. However, it can also be taken by non-tax paying or tax exempt entities as a direct pay, where it's a cash instead of a credit. Unlike 45L, this credit is able to be transferred as well as sold for tax-paying entities on an open market. Similar to LIHTC, you will find brokers who are willing to pay pennies on the dollar for cash now versus realization later. And that market we'll talk about a little bit more in future slides. Lastly, it does operate like the 45L as far as an open tax year allowance. So we can currently look back all the way to 2021 and 2022 under the statutes at play for those particular years. I believe it's a 10% credit amount, but we are able to go back retroactively and access those as well. Next slide. So the considerations and requirements at play is, as mentioned, the cost of the qualified energy facility, as this goes into design elements, infrastructure updates, equipment costs, labor associated. All of that can be figured out to be covered under the ITC credit. The stipulation for the maximum allowed to be considered is that the system cannot generate more than 1 megawatt. This is a vast amount of power. A visual I've helped use is this is about 3 football fields worth of solar panels. You're hardly ever going to see that in some sort of residential property. So usually that is something that can be avoided, but that is the upper threshold limit that the energy property cannot create more than 1 megawatt generated. You cannot stack this credit alongside others except for 45L. Again, we're seeing that alignment from the Inflation Reduction Act that allows that to happen. So these two do pair very well, being energy efficiency associated. The baseline of the credit begins at 6% and is affected by prevailing wage and apprenticeship requirements to also have that 5x multiplier, which brings it up to 30% of the renewable investment. So it's a good consideration. And again, very clear to see the alignment here to maximize these credits, especially in terms of LIHTC opportunities.
All right, we're going to go ahead and launch poll question number 4. So go ahead and get your answers into poll number 4. We'll leave the poll open for about a minute. Please go ahead and get your responses in to poll question number 4. Don't forget to hit the submit button to confirm your response to the poll question. And we're going to leave this up for about a minute while you get your responses in. We will close the poll in the background. David, Sean, back to you guys.
Thank you, Jason. We're briefly going to touch on the bonuses available here for the Section 48. So you can kind of see in this graphic that we've got our baseline credit that, as I mentioned, starts at 6% and moves up to 30%. And then you have other benefits that are like the domestic content sourcing, where if you're buying American-made equipment, you can get a 10% bonus there. Energy communities is also another benefit. If you happen to if the project happens to be within an energy community, which is regulated by the Department of Energy, there is another 10% bonus. So you can start to see how these can begin to stack together. Once you hit that those two bonuses, you begin to get into the non-stackable bonuses here, like a low-income tribal land, low-income residential project, or economic benefit project. The one that's most applicable to LIHTC is going to be the low-income residential project, which gets you a 20% bonus immediately for that. So with prevailing wage paid, you could be looking at a 30% baseline, 20% for LIHTC, and say you source domestically for your equipment, you could be upwards of 60% of these projects being recouped. So a lot of benefit here. Something to be considerate of is that some of these bonuses require applications to be approved, and there can be timing considerations based on the year and when this is happening and when those award periods are open. So it's a good factor that when considering these credits to really talk with people who understand the program so that you can get those timing requirements and considerations nailed down. Lastly, I want to briefly touch on the fact that this is a sellable credit. There is some transfer available. So as we noted, both tax-exempt and taxable entities can access this. Tax-exempt entities will usually take this as a credit, a direct pay, whereas taxable entities will look at it either as to realize for themselves or transfer in the situation of a syndicator, or take it to an open market to sell. This is done through pre-filing registrations that are required. So again, understand that there's some big nuance here to pay attention to as far as making sure that all the T's are crossed and I's are dotted. Once sold or transferred, it's irrevocable and cannot be undone. And this can only be done once by a tax-paying entity, and it has to be done on the original return. So we are not able to go back and sell this retroactively and looking backwards. It has to be done in the current year that it was taken. There is a whole market that exists to broker these credits and facilitate business between entities that have them, that are looking to capitalize on them. So that's a nuance to be aware of as you begin to talk about how these credits can be sold. I'm going to hand this back over to you, Sean, to bring us home.
Yeah, okay. So we kind of talked about a bunch of different tax credits and everything here, and we're just going to kind of try to give you guys a bit of a wrap up here. So high level, Legacy 45L 179D deduction, which we didn't speak about, but if you're familiar with it, and cost segregation do not work well with LIHTC. They all reduce basis, which, since the LIHTC credit is determined by qualifying basis, it would reduce the LIHTC value. Also, with pursuing something like Legacy 45L, and which requires you to amend to claim, most syndicated investors do not want to amend. It's generally large institutional investors, so it costs more generally to amend their taxes than it does to claim these tax credits. 45L going forward works great with LIHTC because it does not reduce basis for the LIHTC calculations, and it pairs well with the syndication schemes, since generally syndicators get 99.9% of the basis in the project during the construction phase. The 45L would just flow to them directly, so it's easy to add into any LIHTC capital stack. The HTC does pair well with LIHTC despite its reduction of basis. Basically, whatever it reduces in basis, the credit amount is more than that. So it's still beneficial to pursue it for LIHTC projects, particularly those 4% ones. There are some ways to claim both without reducing basis, but that would be a conversation for our in-house CPA and not me. And then the Section 48 ITC does pair well with LIHTC. It's similarly can flow. It also just gives more options with the fact that you can sell it, or since a lot of LIHTC projects are done by nonprofits, the direct pay option is great. Cost segregation can be leveraged to make getting the HTC, the historic tax credit, easier. So it is beneficial to always look at cost segregation before you claim the historic tax credit.
All right, we only have a few minutes left, but I'm going to bring up the fifth and final polling question. This is the final opportunity to answer a poll for CPE or CE credit. So please get your answers in. We'll leave the poll open for about a minute and close it out in the background. And David, Sean, just a quick heads up for you guys. We do only have a few minutes remaining. So just wanted to make a note of that. We'll close the poll out in the background when it's appropriate to do so, and we'll get ready to wrap up with the webinar before we hit the top of the hour. Back to you guys.
So Leighton has the in-house expertise to make sure that any tax credits that you're pursuing, we always try to make sure that it's financially viable before we pursue anything too far along, and taking into account all the different technical and financial variances. But let's just kind of get into the Q&A, but while there's still time, if anybody has any questions. We only have a couple of minutes left here. So, Dave, I see a question from Sheena that you could probably tackle. Is The solar energy
Yeah.
generated by the property is tax-free as well.
Yeah, so there is a alternate to the 48 ITC, which is the PTC, which is the production tax credit, which also pays out over a 10-year rather than an upfront recoup of costs. So depending on the circumstances for your client, what makes the most sense fiscally, they can actually get a tax credit based around that production over the course of that 10 years that diminishes in return, highest in year 1, and slowly paying out towards year 10. However, you cannot take both. So generally you want to do a cost benefit analysis of better to recoup a cost versus getting the credit for the energy generated for the facility.
So I see very quick question from Sanjay. LIHTC is non-refundable for tax purposes. So answer that easily. There's also a question from Nancy. I'm not going to try and pronounce last names because I'm not great at it. But it asks would this credit be applicable for units that are on leased land? The 45L tax credit is specifically just for the buildings. It has nothing, the land is not taken into consideration for anything. Dave, correct me if I'm wrong, but I believe the ITC is based on just what is installed on the property, and it's whomever it owns it during the installation would get the credit.
That is correct. Yes. I also want to quickly bring up a question from Michael O'Grady. Can you get the ITC for rehabilitating one historical house? Yes, that is correct. Part of the historic tax credit requirement is just that it must be historical. That's actually managed as a designation through the National Park Service, believe it or not. So there's some good information there around the HTC credit if you're looking to do some additional research. But part of this is that for purposes of capturing the credit, it must be registered as a historical building. And the National Park Service has some guidance on what is considered there, if that's applicable to anybody's individual projects.
All right, David, Sean, I think we are actually just out of time for any additional questions, but if you do have any quick concluding remarks before we go ahead and close out, now is certainly the time for that.
I would just like to say thank you. This is something Dave and I have spent a lot of time researching and put in a lot of effort, and seeing your thanks and appreciation makes it feel like it was well worth our time, and we appreciate you all being here.
Absolutely. To reiterate Sean's points, we're really grateful to have your attention and your interest in here. I have huge passion for energy efficiency, and to see that there's alignment with CPAs here who also are wanting to learn and, help support these causes has a huge benefit to what we're doing as work. So thank you guys, everyone, for joining, for your attention, for your questions. We gratefully appreciate it.
David, Sean, thank you both so much. Of course, we appreciate you and the time that you took today to share your knowledge with our audience here at CPA Academy. Of course, an additional shout out to Ram and Megan for driving the slides and for answering questions in the background. Thank you both as well. And of course, to all of you in the audience for your participation and attendance. Some quick end of webinar housekeeping. CPE will be issued by our team at CPA Academy a little later on today. CE credit for enrolled agents and PTIN holders will be registered with the IRS at a later date. Webinar evaluations have gone out by email. You can also access the link to that evaluation through your CPA Academy account, and you'll also be able to access the handouts for today's session and an archived copy of today's webinar recording once it's available in your CPA Academy account. All that's left to do now is close out and say one more thank you. So thanks all for your involvement in today's webinar. We hope to see you all on a future webinar and hope you all have a great rest of the day.